It's Tuesday, 5th of December, and welcome to the Coinbase Institutional Markets Call. We have a fantastic call for you planned today. We're going to be joined by Anjan Vinod, who is a VP at Parafi, one of the oldest crypto funds in the space. We're going to be discussing real-world assets, modular versus monolithic, DePIN, stablecoins, and much, much more. Alongside Anjan, we're going to have Georg, who's going to run us through a market update, and David, who will run us through some important data we have coming out this week on the macro side of things, as well as his current thoughts on the market. We are sending our best wishes to Greg and to Sid, who are both a little under the weather this week, but we'll hopefully be back next week. Some quick housekeeping. If you want to read all of David and the team's fantastic research, please scan the QR code or click on the link in the show notes to check out the research, which is free of charge. And don't forget to like and subscribe, whether you're on YouTube, Spotify, whatever the platform is. Please like and subscribe. That is how other people hear about the content we're putting together. But let's get straight into it. Anjan, welcome to the podcast.
Hey, Ben. Glad to be here. Thanks for having me.
Yeah, we are very happy to have you here. So can you start with a little bit about what your background is and what your role is at Parafi?
Sure. So a little bit about my background. So I'm on the investment team here at Parafi Capital. So Parafi is an investment firm that's focused exclusively on the blockchain space. We focus on token, equity, and quantitative strategies across our different funds. I've been at Parafi now for more than 4.5 years, so been through multiple market cycles, as I'm sure many of you have as well. And I come from more on the strategy, ops, and research side. In the blockchain space. So yeah, excited to be here and a ton of interesting topics to talk about.
Yeah, let's start with a slightly spicy one. And obviously you've been in the firm 4.5 years. That certainly makes you a crypto OG, and you've certainly seen a lot. I guess if we were to go back 4.5 years now, we probably saw a 3K candle in BTC, which is an order of magnitude lower than where we are now, at least. So yeah, you've certainly seen some things. Now, to that first conversation, there's been a lot of talk this year, especially with the resurgence of Solana around modular versus monolithic chains. I'm curious, you guys at Parafi, how do you think about it?
Yeah, I think it's it's a really, we could have a whole podcast just on this debate. I would say there's when you look at how the market perceives monolithic versus modular, it does seem like the market takes a very binary approach, right? It's either monolithic or modular. But I do think we'll live in a world where both will exist, and that can be a win-win for both systems. So if we look at the current state of blockchain apps today, you have a couple 100,000, maybe a few million daily active users on chain. What happens when that number grows by 100x or 1,000x? Is there an architecture today that is perfectly optimized for the next several hundred million users of blockchains? I think the answer is actually no. I think this will take more and more iterations and evolutions of the actual stack and architecture of these chains. So I think that's an important kind of context to provide. And we've seen that over the past couple of years, right? We all remember the ICO boom, in 2017, and then in 2018, this whole new wave of layer ones, and the market structure of blockchains have changed drastically over the past few years alone. So I'm expecting substantial shift over the next couple of years. So I'll paint just a super high level, I think, pros and cons for both sides, and we can dive deeper into kind of each side. So I think on the monolithic side, what's really clear right now, at least, is that it's just much easier to just start using as the average day user. Right. So if you want to use Solana or Aptos or Sui or any more of these monolithic systems, you download a wallet, you're able to connect to a specific application, and you're pretty much connected to the entire ecosystem, the liquidity. It's a little bit more plug and play, right? And I think that also fits on the developer side as well. I don't have to pick which specific layer 2 or layer 1 I'm going to use, which bridge I need to move my assets over to, which layer 2 I need to use, and maybe the underlying security assumptions of that layer 2. So it's just much easier if you're a developer user to just immediately start using a monolithic chain. And I think today, at least, the fees and throughput on many of the monolithic chains are substantially higher than some of the L2s and Ethereum layer 1 itself, but with some caveats, right? You have to consider kind of decentralization, security, the value that's being settled, and also future upgrades such as EIP4 and 4.4, which are starting to change the fee and scalability landscape drastically. So that I would say is one of the pros on the monolithic side. I would say the downside to monolithic and where modular blockchains I think are really winning is, again, going back to my comment earlier, if we consider how early we are in the market cycle, which is a few million daily active users on chain, what happens when we have billions of users on chain? Blockchains are custodying trillions, if not tens of trillions of dollars worth of value of real world assets, crypto native assets, whatever it may be. Maybe they store information and storage on decentralized storage networks or file networks. When you have this massive ecosystem of value and information, is the current stack today optimized for that future state? And one could make the argument that it's not, right? Each of these use cases, whether it's DeFi, whether it's real world assets, decentralized social, payments, gaming, each of these individual ecosystems and applications may need specific application level changes at the modular level that those developers and companies may want. And that will be abstracted away from the user. But developers do value choice. And especially as we get to the stage of hundreds of millions or billions of users or trillions of dollars of value settled on chain. And then as you think about sustaining attacks from governments, from large companies, there's this massive honeypot in these blockchains, and they need to be resilient. And so that's where I think the modular stack really starts to play out. We're giving developers more choice, right? If you want to make customizations at the VM level for privacy or for ZK proofs, or maybe your gaming application, you want to make very specific changes to opcodes, right? If you want to make changes to the DA that you're selecting, or maybe you want to have your layer 2 or your layer 1 KYC, right? So only certain companies and users can come up with. So essentially, there's a lot more customization that I think developers and users may actually want in the future. But yeah, let me pause there. I mean, I think the short answer is it's a little bit too early to say that monolithic or modular has won. We've made investments in both, but I think there's some really strong pros and cons, and I'm happy to dive deeper, into each.
No, I really like that because, I mean, it's no surprise that these things have trade-offs, and there's always going to be trade-offs. I think that goes for anything you do, right? But I think you have a good sense that one positive of one side is actually the negative of the other. Like, you have a lot of optionality when it comes to the modular thesis, but that optionality can actually work against you, especially if you're a developer who's trying to build fast, and maybe like a lot of these choices aren't going to improve that necessarily. So I kind of like the way you frame that. But do you think that there are sector specific kind of inclinations that kind of drive projects towards one versus the other? Like, do you think that, we've seen kind of projects attract like both, like the modular thesis and a monolithic thesis. But are you really seeing like kind of momentum being driven towards one or the other?
Yeah, it's interesting. It's, every market cycle, starting in 2017, it feels like there's a pendulum, right? In 2017, it was all Ethereum. Then in 2018, 2019, a bunch of Ethereum killers came to market, and it felt like the market pendulum swung to the other side in terms of developer and user interest. Then it was back to Ethereum, and then DeFi summer happened, and gas fee spiked on Ethereum. Then it went back to the alt layer one. So it does feel like the market as a whole is trying to figure out what this is in real time, which I think is great for the space. So to answer your question directly, I think today there are definitely applications that benefit from building more in a monolithic environment versus a modular environment. So you look at the monolithic environment, today, if you are really valuing, composability, right? So maybe there are specific applications that you, for example, are a money market or a DEX, and you are reliant on hundreds or thousands of other assets across the ecosystem. Maybe if you're a DEX, maybe you're plugging into a money market to provide liquidity. Maybe some of the liquidity goes for payments. There's a whole range of composable use cases that I think could start to break down in a more modular environment, right? So in a monolithic environment, in theory, if you have liquidity that's aggregated in one ecosystem end to end, and then with that, a lot of the apps themselves can remain composable with that liquidity or user base or integrations with protocols without having to rely on different bridges or different L2s. There's a lot of value in having that in one specific kind of ecosystem, right? And then if you look on the modular side, there's a lot of value in being able to customize what's actually happening end to end. So if you look at, DYDX, right? So they started off on Starknet and then moved over to build their own Cosmos chain. And, now they're optimizing their whole trading infrastructure, their node infrastructure for trading specifically, which is really interesting. And that composability isn't broken per se because they don't need thousands of different assets to move over. They're relying on stablecoins and oracles to kind of replicate and create the kind of exposure to the assets that they want. So you don't lose that necessarily, that composability immediately. So I think it very much depends on a couple of kind of core points, right? Do you need composability? Do you need ties to specific liquidity or infrastructure? What security trade-offs are you okay taking? As I look at the modular stack today, you are trusting sequencers. There's a number of bridges you may have to trust, and there are benefits to that, though, right? So if you look at a project like Kinto, so Kinto is building a fully KYC'd layer 2 on the Arbitrum stack. And what's unique about something like Kinto is every user and developer is KYC'd, and that's encoded at the layer 2 level itself. So for you to actually come on board and start using a DeFi app or sending payments, you have to be KYC'd. And so this level of customization at the base layer itself is incredibly valuable for developers and users in the ecosystem. So I think it very much comes down to, again, some of these core points around composability, security, et cetera. But what is interesting is I think developers are not tied to specific ecosystems for the long term. They're still figuring this out in real time, as shown by protocols like DYDX.
Yeah, I think that's a super interesting way of breaking things down. Now, I'm curious, when people look at monolithic versus modular, typically kind of Solana versus Ethereum, maybe one of the lazy ways of looking at it is that NFTs all on Solana because it's a mass market product and you kind of get quick finality. What is it, 1 cent under 1 second is something that they're kind of very proud of. Do you think it's that simple? If we were to fast forward 10 years and we have, assuming it's not a one chain win all, and we have Ethereum and Solana and various others, do you think that you're going to have all the NFTs on one chain and then all the DeFi on another chain and all the real world assets on another chain? Or is that just a slightly oversimplified view of what the world may look like?
I think it's definitely possible. But I think today it doesn't seem like that's incredibly likely that you see all of this aggregation on one specific chain or instance. I do think there are power laws. I don't think this is aggregated across 1,000 different chains, but I think one chain is a little bit too difficult to underwrite at this moment. And so what you may see with Ethereum, for example, maybe some of the high value assets, whether you're settling a $100 million trade or an RWA asset, which itself could be an NFT, may want to settle on something that's a little bit slower and maybe is seen as more secure and more decentralized in terms of its uptime, security, et cetera. And then something that may be low value, to your point on consumer applications, someone buying a $5 digital collectible may settle on another chain. But again, I don't think it's either or per se. I think it's very much use case specific.
Very cool. And you mentioned kind of real world assets there. I know that's a space that you guys are interested in and have probably done some work. Can you kind of break that market down for us? So in the prequel to this, there are a couple of stats you brought up that really, really surprised me. So how are you thinking about real world assets on chain and where is the focus? Where should we be keeping our interest at the moment?
Yeah, so real world assets is I think one of the most interesting sectors in the crypto space right now. We've been actively deploying in this vertical for several years. It all started off, I think, in 2017, 2018 with security tokens and excitement around a lot of those tokenized assets back then. And now we have the actual infrastructure, whether it's stablecoin infrastructure, scaling, liquidity on chain to actually scale RWA specifically. So in the RWA space, depending on how you calculate your definition of RWA, which chains you include, you're looking at a couple billion in TVL, and this has seen massive growth year to date. So you have around 750 to 800 million in tokenized treasuries, right? So as DeFi rates fell below real world rates, you started to see this movement into tokenized treasuries, which are offering significantly higher rates that offer better risk return. On top of that, you have gold, which is close to $1 billion in tokenized gold that's sitting on chain. You have private credit, and asset-backed finance. You have some funds, like KKR that have also tokenized and launched on chain. You have companies like Franklin Templeton, Hamilton Lane. JP Morgan has their own Onyx blockchain, which I think processes around $1 to $2 billion a day. I think close to $1 trillion since inception. You have blockchains like Provenance, right, which are more permissioned blockchains, which also has several billion of TVL tied to Figure Stock, but also HELOCs, home equity line of credit. So I think what's interesting is we've moved from just stablecoins being tokenized to a wide range of assets that are being tokenized, and the growth has been exponential over the past 12 to 18 months, and we expect that will continue. And what's been really interesting as an investor is there is a whole RWA stack that's emerged, right? So similar to what we saw in DeFi in terms of a whole stack or NFT and gaming, there's now a whole RWA stack that's emerged, and several high-quality companies that are building in that space.
So I love this idea, but I think one of the pushbacks to this is that a lot of the tokenization is happening on private rails. And what we are trying to look for is that connection between private and public rails. Like the tokenized treasuries you mentioned, many of them only available to like accredited investors, for example. Like, right. Some of them, a majority of them are also offshore. They're non-US citizens, for example, or non-US residents, for example. So what is the path you see from getting this from private chains, which it makes sense, right? Like they need to have compliance-friendly kind of vehicles. So they often don't want to invite the scrutiny of being on a public chain. Rather than that, they'd rather just build it in-house. But what brings you to the public side of the equation?
Yeah, I think there's a couple of points there. So the one there is this overarching regulatory framework that needs to be established for institutions to actually transact on chain. I do think, fortunately, real-world assets are in a much better position than DeFi assets, right? So crypto-native assets, permissionless assets, anyone can access. There's an open question of who can actually trade them, use them, globally, depending on which jurisdiction you're in. So I do think there is a regulatory component. Fortunately, there's a lot more framework and guidance, I think, on the permissioned and real-world asset side, given you have existing securities laws to use for that. So that's, I think, one component. Then there's more on the, technology side itself. So these large institutions, instead of kind of waiting around for that perfect clarity in terms of where they can build, where they can operate, they have to start somewhere. And so if you look at the Provenance blockchains, the JP Morgans of the world, them starting on the private blockchain, and these aren't new projects, they've been around for years, is actually quite bullish for the vertical as a whole. You start in a more centralized private setting. You understand some of the nuances around building on blockchains, composability, developer tooling, infrastructure, et cetera. And then when there's a little bit more clarity, whether on the regulatory side, on the product side, you're now able to move into more of a permissionless environment. But I do think there are some challenges of launching, RWA and tokenized assets in a truly permissionless manner, like Uniswap, right? Can anyone that's not KYC'd or anyone in the world access a certain, security or tokenized asset? There may be issues with that, right? And so maybe this hybrid, to your point, is instead of waiting for all these, permissioned private assets to be freely available on Uniswap or on any layer one, maybe there's a middle ground where there are KYC'd or identity-based, ecosystems, whether it's a Kinto or Provenance that are more KYC'd, or even on Coinbase base itself, which with its ID product, where only certain users at the smart contract level can access these products. So if you have capital on chain, you're trading on chain, you're maybe using a decentralized social network, you're using a DeFi product, you can still access these products, depending on whether you're accredited, whether you're a qualified purchaser, whether you've been KYC'd in a certain jurisdiction. But that's at the smart contract level, and an identity now becomes this base layer that allows for composability of assets, globally.
Interesting. Yeah, we had a lunch with MC from Uniswap last week, and she was talking about V4 and some of the things that you can do around that with hooks, such as KYC pools of liquidity, exactly. Which I think, I think once we have a little more clarity, will be an area of growth for them. I'm curious, like if we look to 2024 now, 23 was a big year for RWAs. We can kind of laugh. It was a narrative in 2017, 18. We've kind of been there, done that. This time, I think, just from the stats that you mentioned, it feels like it's getting some real traction. But I'm curious, looking at 2024 with the tailwind that we've got right now, like what are some of the ways that you think this space will continue to develop in the next 12 months?
Yeah, so I think tokenized treasuries are a great gateway to get more assets in. So if we're sitting in the US, we may ask ourselves, why does someone want to buy a tokenized treasury? You can go to a brokerage, right? But that's not the case for the 130 billion of stablecoins that are sitting on chain, the vast majority of which is earning either zero yield or earning a yield less than treasuries, right? So there's already a massive market that's untapped that could move into essentially allocating to tokenized treasuries. And the powerful component of that is once you're in the tokenized treasuries world, we think there will be a whole new suite of other products to allocate to, right? Whether it's gold, there's private credit, asset-backed financing, emerging market debt. There's we can go into all these different verticals, real estate. And so these verticals now feel real. There's actual products, actual liquidity, and actual traction. And so we do think the tokenized treasuries component will serve as a gateway to get some of those additional, get exposure to additional assets. I do think right now is what's really positive is you look at the number of banks, whether it's central banks, private banks, large companies exploring the tokenization and blockchain space. I mean, you see McKinsey and Bank of America, they're all putting out these massive 50, 100-page reports on tokenization, covering in depth the value of tokenization. So I think, the market and ecosystem is really starting to wake up the value of tokenization real assets. And I think what maybe the market and the ecosystem got wrong in 2017 and 2018 was, hey, just because you tokenize something doesn't mean things are automatically liquid and valuable. But what's changed now is you have the liquidity on chain, you have the infrastructure on the scaling side, and the most valuable component from my perspective of tokenization is programmability. So now we're seeing a whole new range of programmable use cases emerge, whether it's on payments, on treasuries, on asset-backed financing, whatever it may be. And that's where we think we see, the next big unlock is what are these programmable use cases of tokenized assets? That's where you start to see a 0-to-1 improvement over the existing financial stuff.
Yeah, I think if 2023 is going to be known for anything, it's the resurgence of all these themes that a lot of people assumed had just been, gone to the wayside. And I think tokenization is one of them, right? Like, I think the idea that, and to be fair, so many things had to line up to get us to that point. I think one of the reasons that, it didn't pick up back in 2017 was also because it was so new and it took time for people to understand it better. One of those areas is also like DePIN, or decentralized physical infrastructure. And, we kind of talked about this before, but I think that's one where a lot of people dismissed Helium, for example, and kind of criticized that project and then kind of criticized the whole DePIN movement as a whole. But now we're starting to see that come back. I would love to kind of get your thoughts on, what's driving this movement. Where do you see the future for it?
Yeah, absolutely. So DePIN, which is, I think, one of the more crypto native use cases, and it's a use case that I'm incredibly excited about, essentially using these token networks and crypto rails to incentivize some off-chain or real-world behavior, right? So with Helium, for example, users are paid the HNT token to set up hotspots, which then power a network, 5G network, IoT network, whatever it may be. And so this use case was incredibly powerful starting in 2021. And frankly, Bitcoin is one of the OG or native DePINs, right? You were paid to run computers and provide network power to the network to validate transactions, right? And then over the years, that same model has now been explored, which is, can you use tokens to incentivize some specific behavior? And so I think in 2020 and 2021, DePIN was really seen as an experiment, a POC. You had companies like Helium that really scaled on the supply side, but the demand side was still missing. What's changed now in the past 12 to 18 months is you're seeing a next generation of DePIN protocols come to market that aren't fully reliant on the token side to scale, right? And what I mean by that is they may have a off-chain native product or demand that's also tied in to the crypto component as well. So I think in the next 6, 12, 18 months of DePIN, you'll start to see more verticals emerge within DePIN. And what's really exciting there is we'll take the learnings of the previous cycle, specifically around token distributions and emissions, and use that to drive a lot more value. So protocols in 2020 and 2021, they may have allocated too many tokens to early contributors, right? And you had this vicious cycle where as the price went up, people were incentivized to do something, and the price went down, and suddenly people weren't incentivized to do something. But now in this next iteration of DePIN protocols, you're seeing companies restructure the way they're giving away tokens, right? So maybe there's a time lock component. Maybe they explore a fleet model, right? So instead of going after every single user to perform some type of action, maybe you go after fleets, right? More sophisticated users. You can structure more bespoke deals to scale the network, right? Maybe you're very maniacal and thoughtful around what is the dollar amount of tokens you're giving away and what is the ROI on that. If we use a traditional software metric, you may view that as CAC versus LTV, right? So how on the CAC side, how much are you spending from a dollar perspective, whether it's tokens, cash, whatever it may be, to get some additional user on the network or additional node on the network, and then for paying that, what are you getting in terms of value? So you're starting to see just a whole new way of evaluating the DePIN ecosystem, how projects launch their tokens, scale their networks, and we think this is going to usher in a much more healthy and sustainable, DePIN ecosystem.
That makes a ton of sense. I'm curious. So we've got obviously Helium, and then there's Hivemapper and Demo, and you've even got DePIN around AI compute, so kind of Render and various others.
Right.
Which are the ones that you're most excited about into 24?
Yeah, so I do think Helium remains quite interesting. I think I would say the market and maybe the ecosystem was so focused on what happened in 2021 and 2020. But what's really interesting now is they've launched the 5G and mobile component. They're live in Miami and I think coming live into a few other markets. So that's incredibly powerful, right? So you've spent all this time and energy scaling on the supply side, then now you're ready to really scale up the demand side. So I think Helium continues to be incredibly interesting. Hivemapper, has mapped something like 10% of the world's roads. They're continuing to scale their ecosystem, and I think it's actually quite impressive if you consider, again, going back to what I was talking about, LTV on CAC, the amount of tokens they've distributed, the value they've given to actually acquire, the 10% of the world's roads. Protocols like Arweave on the storage side are actually quite interesting, and there's a lot of angles on the DA as well. Maybe potentially some of these storage networks acting as DA. So, it's quite positive to see all of these, different verticals, come to market. And I think what's been most exciting is just this change in, the token economics and the emission schedules.
So I feel like all these projects tend to benefit from the same sources, which is we need liquidity, right? We need liquidity in the space. And that kind of brings up the idea of stablecoins, which play a very unique role in our ecosystem, but it's starting to broaden out. Like it's really starting to touch the real world economy in a lot of ways. And I think that's why we're starting to see more like regulatory frameworks around this coming up. What are you seeing as far as the landscape for stablecoins? Do you see this changing, gearing more towards payments, like adding on yield? Like where do you think the volume is going? Like there's just so much to the space.
Totally. Yeah, I think stablecoins is probably, outside of Bitcoin and Ethereum and some of the base layers, is probably the vertical that has undeniably reached some level of product market fit, right? So stablecoins, really launched in, 2018 from the USDC side. Tether was obviously earlier, but really started to take off during DeFi summer. And what's been interesting over the past couple of years is there's been a lot of focus on the market cap of stablecoins, which sit at around 130 billion, but a little bit less focus on what's actually happening at the transaction or blockchain. What are people actually doing with stablecoins today? So stablecoins did close to 11 trillion in volume in 2022, not that far away from Visa. PayPal did 1.6 trillion in volume, so substantially past PayPal and several other networks as well, in a very short period of time, right? In just a couple of years, stablecoins have done that. And what's also fascinating about those data points is this is off a small base of users, right? You're talking about a couple 100,000 DAOs, a couple million probably at peak that are actively using stablecoins today, and yet we saw massive volume. So stablecoins, I think, are in a very good position for additional adoption. But as we take, we go one level deeper on what the volume actually looks like. What's interesting is to see some of these emerging market use cases where stablecoins may actually be a much bigger opportunity, right? In the US, whenever I talk about stablecoins, people always say, "Hey, we have Venmo." Right? But even Venmo itself has a number of issues, right? It may take several days to settle. There are limits on how much you can send. Cross-border payments, a huge opportunity for stablecoins. I think the average remittance fee is anywhere between 3% and 7% just to send money globally, right? And that may vary depending on which country you are, how many banks you have to go through, what merchants you're using, whether you're going into cash on the other side. And then talk about the time it takes to actually settle that. I mean, this may take several days to a few weeks, again, depending on where you're actually sending money to, versus in the stablecoins, it can cost a fraction of a cent. You get the stablecoins immediately, and you actually own those stablecoins, right? They're not held with some merchant or bank, or you actually own those stablecoins natively. So there's some really interesting emerging market use cases that we've been tracking. So you look at USDT in Argentina, you look at USDT in in Turkey, and a lot of those volumes are, interestingly enough, on Tron versus Ethereum. So if you look at Tron's annualized volume, it's doing anywhere between 3.5 and 5 trillion in annualized volume. That's incredible when you think about the volume that USDT is doing on Tron versus Ethereum. So USDT is doing more volume on Tron than Ethereum, and that could be driven by exchanges like Binance, market makers in Asia, and of course these emerging market use cases. So that's a really interesting dynamic that we've been paying attention to. And then you look at the number of kind of stablecoin focused apps that are making it super easy to send money. There's Sling and Beam, there's Juno, there's TipLink, and so it's actually much easier to send stablecoins today. We have the scalability, there's liquidity. There's a lot to unpack there, but I'll pause there and we can dive into anything specific.
Amazing. We'd love to dive into the consumer side of things. So you mentioned Venmo. I'm in the US now. I was originally from the UK, and that was one of the first apps I downloaded just to kind of pay people $5 here or $5 there or whatever. And I guess what I love about it is that it's a network that encourages others to join the network because of the utility increases as more of your friends have it, et cetera. So when I think about ways of how we can help crypto grow and just expand the number of people with a wallet on their phone and with an ability to send and receive crypto, do you see consumer applications like that as kind of having a good shot of helping the whole industry grow from a kind of more retail and consumer perspective?
I think in the US, there just isn't as much of a dire need to go to stablecoins, right? If you have credit cards and debit cards, cash, you have apps like Venmo and Zelle and Cash App. I don't think the user is screaming to run over and use stablecoins, right? There are some inefficiencies, right? Whether it's the time it takes to settle the cost, there definitely are some inefficiencies there. But when you compare that with potentially the non-US opportunity, whether it's emerging market, cross-border payments, remittances, that to me feels like a much bigger opportunity. But to answer your question directly in the US, the value of stablecoins is not just, hey, you may save a little bit of money, it may settle a little bit quicker. It's really, again, the programmability, right? So people talk about Venmo, they talk about Zelle, they talk about even FedNow disrupting stablecoins, right? FedNow is a system that's being rolled out by the Fed to settle, wires and bank transfers and immediately. But you can't program on top of FedNow. You can't program on top of UPI per se in India. Versus stablecoins allow anyone to program applications, right? So whether it's recurring payments or payments from a company sharing value to its shareholders, right? Or a lot of these DePIN protocols, if you have to pay contributors. I mean, there's so many crypto native use cases and Web 2 and real world native use cases that can benefit from programmable payments. And what that means is that reduces the number of intermediaries and costs and inefficiencies in the system. So I do think the adoption of stablecoins look very different in the US than, say, in emerging markets. But the overarching theme that I think is the most powerful component about stablecoins is programmability.
Amazing. Do you think there's any other opportunities that you think we're missing in the crypto space? I know that in the past we've spoken about like prediction markets and things like that. Anything we didn't cover?
Sure. Yeah, absolutely. So, Augur, there's V1 and V2 for those who are around then. Augur V1, I think initially launched with ETH as a settlement currency, which is super volatile and difficult to use. Obviously, if you're betting, $1,000, $2,000, the scalability wasn't there. It was very expensive to actually use Augur. Just trying to run this order book and all this complexity in terms of running this on chain. Some issues around settlement. There was some subjectivity. So Augur had, I think the vision was incredibly exciting, but there were a number of known risks and challenges, whether it's liquidity, the infrastructure, the costs, that didn't allow it to really scale. And now you're seeing a next generation of protocols that really take this to the level, whether it's Polymarket, for example, which has done several hundred million of volume. Its election markets are one of the most liquid markets there are to actually bet and trade on the election. And you'll notice Polymarket, just using that as an example, is actually quoted in mainstream media for different stories and topics in terms of how does the market actually perceive a specific event playing out, right? There isn't a Web2 company and protocol that is as liquid and as scalable as something like Polymarket. So why are we in a different state today? Well, you have infrastructure like stablecoins that make it very easy to actually bet in small size or large size on prediction markets. You have scalability, right? So it's actually easier to put a larger number of bets on chain. You have AMMs and order book innovations that, depending on the size and the market structure of the prediction market, you may actually want to use an AMM, and that could be more of a V3 or V4, Uniswap V3 or V4 type perp, or something that's more of an order book system. You have RFQ systems coming online for prediction markets, and I think most importantly, you have broader awareness and adoption of prediction markets, which for the elections, for example, prediction markets are one of the most powerful indications of where candidates stand in real time.
So looking at Polymarket, how accurate do you think some of these markets are relative to the kind of correct theoretical probabilities?
Yeah, well, it's an interesting question because it really depends on what your definition of what is correct. Like something pre-settlement, like what is actually seen as the source of truth, right? So if we're looking at the market on the election, it's predicting who's actually going to win the primary, who's going to win the presidential election, what is considered the source of truth? Is it the polls, which are one way of looking at it? They have their own flawed representation, right, in terms of how they collected the data, verified the data, the sample size, all of that. Is it potentially media, right, that's saying that, hey, this candidate's not doing that well, this candidate's doing better? Or is it a market where people have to put money where their mouth is, and there is a level of volume, and that all of this is taking in kind of real-time data? So I think it's quite powerful to have a real-time market that's able to collect insights on the world, take those insights and information, and then allow market participants who have their own unique areas of expertise to make bets on those specific verticals. So, I think moving forward, it'll probably be a combination of everything, right? It won't be that, hey, media is completely right or wrong, or maybe these polls are right or wrong, or maybe something like Polymarket's right or wrong. Is Polymarket just adds another dimension to what's actually seen as a truth, or what the market or society feels about a specific topic.
Very cool. We'll certainly be checking out Polymarket a little more, and especially ahead of the elections and all other things worth keeping an eye on. And then thank you so much for that. A really broad-ranging conversation with a ton of interesting insights, and a lot for us to think on. So thank you so much for joining. I hope you stay with us for the rest of the call. And we really appreciate your time. Thank you. Absolutely. Thanks so much, guys. That was fun. Thank you so much, Anjan. We covered a broad range of topics there, and I love the detail that you can go into across such a broad range. It's fantastic. I hope you'll stay with us for the rest of the show, and thank you so much for joining. Now, George, over to you for a market update. It's been a pretty good week, I think. So what's been happening?
Yeah, thanks, Ben. Definitely a very exciting week with Bitcoin now around 42,600. So it's up around 13% over the last 7 days. After we spent a good couple of weeks consolidating around 35 to 38K, that range. Obviously, MicroStrategy announcing that they've been restarting buying larger amounts again has helped, and then planning additional equity issuance as well. But I think there are other aspects as well that came into play here. So obviously a good amount of liquidations above a 40K, which was a very important psychological level. In fact, the highest since the Lunar collapse in May 22. I think other things that played into this were DeLi gamma positions, which also created forced buyers, so to speak. But having said that, obviously, I think it's important to bear in mind that there's a lot of euphoria now, and that's not to say that we can't just keep rallying. But you can also see that in the funding rates. I was checking a couple of venues yesterday that were offshore, and you were getting funding rates in Bitcoin around 70% on some of these venues. So the big question is, how sustainable is this rally in the short term? Interestingly, actually, in ETH, the funding when Bitcoin was hitting 70% or so was significantly lower, around 30 to 40% range.
Yeah, interesting. I mean, when you're talking to clients, George, do you get the sense that they are kind of starting to think about moving out on the risk curve. So obviously a big run in BTC and ETH, funding rates are high. Typically, these are things that we see when the market starts to heat up a little bit. And the next potentially logical step is to go to some of the longer tail stuff further out on the risk curve. Are people doing that now, or is it still a bit too early?
I think it is slowly starting, but I think there's definitely a stark difference between what institutions are doing and what you can see in the retail segment. I think Greg actually had this interesting chart, that shows you the breakdown of dominance of volume traded by asset in one of the last calls. And the broader exchange, I think, we now obviously whereas in the summer, ETH and Bitcoin were maybe 90%, 90, even maybe a little bit higher even of overall volume traded. I think that's definitely moved down to 70-ish range. So obviously, I think that's more so on the retail side. Now on the institutional side, we can see that that tendency as well, that you do have a lot more interest in altcoins. But I think, given the lessons from the last bull market, generally people are a little bit more cautious and a lot more conscious of liquidity and position sizing, etc. But I think it is slowly starting for sure.
Yeah, so certainly cautious for now. We'll see what happens when Bitcoin that's 70K. But no, I'm 100% with you. That's fantastic, George. Any other news that you've been keeping an eye on, or things that have jumped out at you?
Yeah, so staying with that altcoin versus Bitcoin and ETH topic, BTC and ETH combined market cap dominance is at 72% now, and it looks like it's a local high there. Looks like we're headed higher because obviously on the one hand you have that ETF narrative, which is quite strong both for Bitcoin and ETH in particular, and also from the macro side, it's becoming more attractive with I think roughly 150 basis points worth of hikes priced in the US until end of Jan 2025. Now, to put that into context, if we look at the highs of the previous bull market in terms of the combined dominance of BTC and ETH, we were at 87% in Jan 2021 last time. Obviously, there's a lot more projects out there right now, and a lot more projects that have, I would say, very high potential and with very strong engineering teams behind it. So I would probably struggle to see it going as high again. But having said that, it just given these narratives for the time being in the short to medium term, I would not be surprised to see that number grow from 72% at the moment. And obviously, until after that, at some point, I guess we will see larger scale rotations into altcoins. But on the other hand, obviously, you do have some examples already where we can see these capital rotations. So Stacks has been a popular one over the last couple of months and the last couple of weeks in particular as well, where you always tend to see, when Bitcoin starts to consolidate and maybe sell off or a little bit in the shorter term, you see this rotation to Stacks. So that's up 77% over a week. And then Celestia is actually another example that did very well. So that's up 45% on the week. Obviously launched at a very opportune moment in terms of where the market or the market cycle stands, and obviously also plays into this popularity of modular versus monolithic chains currently.
Yeah, I have to say, I think the Celestia launch is probably one of the best launches I've seen. Now, obviously, you point out very correctly the market maybe helped out a little bit there, but that's still, I found that very, very impressive.
Yeah, 100%. Definitely great. I think, although, I mean, maybe we're also a little bit biased after 1.5 years of bear market. So, but I do agree with you. That was a great launch.
Yeah, we forgot what green looked like, but yeah, glad it's back. That's great. Thank you very much for that rundown, George. David, over to you for some macro.
Yeah, thanks, Ben. So it seems like a lot of banks actually are pushing back against the rally we've seen in risk assets like equities. And, you've seen like Goldman, Citi, Morgan Stanley, all kind of saying that we've actually had a decent run up. And, now the market is over its skis on expectations about the Fed rate cuts. I'm not necessarily in that same camp. Like, I'm still fairly constructive about the rest of the year. But I certainly think that we've already had quite a decent rally, but it's still going to be contingent on the economic data itself. And we've got the non-farm payrolls number coming out this week, retail sales coming out this week. I think there's still the inflation print. So I think all this matters to kind of lead up to what the Fed is going to do on December 15th, but also kind of what's going to happen over the next few months. Like I very much do believe that we're now done with rate hikes, and very likely the next move from the Fed is going to be cuts. But it doesn't necessarily need to be immediate, right? It doesn't need to happen like this month or next month. Like I think very likely we will see that probably start in second quarter, probably more towards the end of the second quarter of 2024. And the Fed itself is probably just going to remain on the sidelines, just because we've already heard from like Chris Waller, who I think is really important as far as transmitting the signal for what the Fed kind of believes and what the Fed's going to do, which was followed up by Jay Powell last week, who kind of confirmed it, that for the most part, we're okay in the economy. We're in a disinflationary environment now. Growth is not stalling, but it's not rising terribly. Like if we kind of stay in this place, that is the Goldilocks scenario. And I think that can continue. Doesn't mean that first quarter 2024 may not present its own set of challenges. And I've kind of enumerated those on this podcast before. But I think for the time being, we're still in that nice kind of sweet spot. And I think that we have room to continue, even if the magnitude might not be as high as it was in the last few weeks.
So David, a lot of market commentators are saying that markets are kind of priced to perfection at this point. And as you mentioned, we've got a lot of data coming up. What do you think happens if we get a data point which is conceived as negative for the market? Does crypto run its own race, or does it potentially get brought down with traditional markets?
Well, that's the interesting thing that we've seen with crypto markets, especially over this weekend when we saw like Bitcoin break into just like new levels that were just definitely caught me by surprise, but I think caught many people by surprise. And that's juxtaposed against what happened in traditional risk assets like equities, which actually didn't do as well. So, like my thesis has been that the last 2 weeks has actually been driven more by macro sentiment and just the positive macro sentiment that people have had with regards to this easier monetary policy environment that we could be in. But it does seem that crypto has its own idiosyncratic momentum here that's driving it up compared to like the modest grinding to downside that we've seen in equity markets very recently. So I think that part of that's the ETF expectations, but I think that there's very much its own story, and you can kind of fill that in on what you think that's going to be. And there's kind of elements of the gold story in terms of the store of value, like relative to like lower rates in the U.S., for example, things like that I think are playing into this. But certainly, I think it can carry its own weight here.
Great. And what about any kind of crypto-specific factors we should be looking out for? Obviously, the ETF is a big one. We probably don't need to cover that. But anything else you're keeping an eye on?
So we've said it on this podcast before, but it's not just the ETF narrative, but it's the ETF narrative alongside all the other things. And the macro isn't divorced from that, right? Like I think we get pushback sometimes when people who are saying like, well, if the macro is relevant, then what is like a token like Bitcoin or cryptocurrency? And I'm saying like we live in this world, so we still depend on like driving the narrative of what Bitcoin or other cryptocurrencies are, as far as, okay, these are things with a fixed supply schedule, which are really relevant when we're talking about looking for alternatives in the world due to, say, a regional banking crisis in the U.S. or turmoil in the geopolitical universe. Like, I think these things these things matter. So that's the framework on which I also look at things like the halving, or things where I look at like potential like changes in the ecosystem from a like monolithic to a modular thesis, or maybe the competition between modular and monolithic. Like I think all these things are playing out right now because we're getting closer and closer to not just store of value significance from a financial kind of framework, but also the technological kind of aspects of like the next use case, which I think we're starting to get to and may be looking at in 2024.
Very cool. Yeah, a lot to be excited about for 2024. I'm certainly very, very excited to see what the next year brings us. Thanks so much, David. Appreciate that color as always. And that is a wrap for today. A big thank you to Anjan, to David, and to George and the fantastic production team. Thank you for listening. We'll see you next week.